In this video, you will learn the exact break-even math for a mortgage refinance in 2026. We will cover fees, APR, discount points, and the one number that decides whether refinancing is worth it for you. By the end, you will be able to calculate your own break-even month in minutes. First, what break-even really means. Break-even is the moment your monthly savings from the new loan have paid back every upfront cost of refinancing. Until that month, you are behind. After that month, you are ahead. To do the math, you need 5 inputs. Your current loan balance, your current interest rate, your remaining term in months, the new rate and term you are offered, your total refinance cost, including points and any prepaid items that are not true costs. Now, a critical point. Not everything you pay at closing is the refinance cost. Some items are just moving money around. Prepaid interest, escrow funding, and new property tax deposits might be required, but you often would have paid something similar anyway. The clean approach is to separate costs into true costs and prepaids. True costs usually include lender origination or underwriting fees, appraisal, credit report, title and settlement charges, recording and lender points. Prepaids usually include daily interest to the first payment date, initial escrow deposit, and homeowner's insurance if paid upfront. If you receive an escrow refund from your old lender, subtract that from the new escrow funding because it offsets the cash you bring. Now we calculate the monthly payment difference. Use principal and interest payment on the old loan versus the new loan. The payment formula is payment equals balance times monthly rate times 1 plus monthly rate to the power of months, divided by 1 plus monthly rate to the power of months minus 1. Monthly rate is annual rate divided by 12. Months is the remaining term for the old loan and the new term for the new loan. Let us do an example with round numbers so the process is crystal clear. Assume you owe $350,000. Your current rate is 7.25%. You have 300 months left. That is 25 years. You are offered a refinance at 6.25% for 300 months. Closing costs are $6,500 in true costs. You also choose to pay points. Before points, calculate old payment. Monthly rate is 0.725 divided by 12. That is 0.60,417. New payment monthly rate is 0.625 divided by 12. That is 0.52083. Instead of doing the full formula on screen every time, you can use any mortgage calculator. But the key is you must compare principal and interest only. With these inputs, the old principal and interest payment is about $23.87 per month. The new payment is about $21.55 per month. Monthly savings is $232 per month. Now, the simplest break-even. Break-even months equals total true costs divided by monthly savings. 6,500 divided by 232 equals 28.0 months. That is about 2 years and 4 months. But we still have points. Points change the math because they are upfront cost paid to buy down the rate. 1 point is 1% of the loan amount. On $350,000, 1 point costs $3,500. Say you are offered 2 choices. Option A, 6.25% with 0 points. Option B, 5.875% with 1 point, costing $3,500. Now you have 2 break-evens. First, refinance versus no refinance. Second, points versus no points. Let us compare option A and option B. Keep the same balance and term. If option A payment is about $21.55, option B payment at 5.875% is about $20.71. The extra savings from paying 1 point is 84 per month. Points break-even months equals points cost divided by extra monthly savings. 3,500 divided by 84 equals 41.7 months. So if you expect to keep this loan longer than about 42 months, the point may pay off. If you expect to sell or refinance again sooner, the point likely does not. Now combine it all. For option A, total true costs might be 6,500. For option B, total true costs become 6,500 plus 3,500. That is 10,000. Option B monthly savings versus the old loan becomes 2387 minus 2071. That is 316 per month. Break-even months for option B versus old loan is 10,000 divided by 316. That is 31.6 months. Notice what happened. Option B has a longer points break-even, but the overall refinance break-even can still be reasonable because the payment drops more. Now let us talk about APR. APR is not the rate you pay. APR is a standardized way to spread certain finance charges over time to show the cost of borrowing. APR is useful for comparing offers, but it can mislead if you do not keep the loan for the full horizon used in the APR calculation. Here is how to use APR correctly in refinance decisions. If two lenders offer the same note rate, the one with lower APR usually has lower finance charges. If two lenders offer different rates, APR helps you see the trade-off between rate and fees, but you still must compute your personal break-even using your expected time in the home. Now we add the missing piece most people ignore. The true monthly savings is not always the payment difference. You must adjust for mortgage insurance, and for taxes and insurance if they change, and for the opportunity cost of cash. Mortgage insurance. If refinancing removes PMI, add that PMI amount to your monthly savings. If refinancing adds PMI, subtract it. Cash cost. If you bring cash to closing, that cash could have earned interest elsewhere. A simple conservative adjustment is to assign your cash a monthly cost. For example, if you bring 10,000 cash and your alternative return is 4% annual, the monthly cost is 10,000 times 0.4 divided by 12. That is 33 per month. Subtract 33 from your monthly savings when computing break-even. This makes the break-even more realistic. Now let us apply that to the example. Suppose you paid 10,000 total true costs out of pocket. Opportunity cost at 4% is 33 per month. Option B savings was 316 per month. Adjusted savings is 316 minus 33. That is 283 per month. Adjusted break-even becomes 10,000 divided by 283. That is 35.3 months. Next, consider rolling costs into the loan. If you roll 10,000 into the balance, you are financing the costs, not avoiding them. The payment will be higher than if you paid cash, and the interest you pay on that extra balance is part of the true cost over time. For break-even, the easiest way is still to treat costs as costs. Then calculate payment based on the increased balance and use the new payment in your monthly